Most founders know how to talk about traction and selling their big vision. Far fewer know how to evaluate risks before quietly draining their time, money, and future options. In today's episode, 𝘳𝘪𝘨𝘵, who is an author of 3 popular books, host of the Make Better Wealth Decisions podcast, and fiduciary advisor to successful families, he breaks down why emotional investing, founder sacrifice, and hype-driven markets are creating dangerous blind spots for healthcare technology founders and startup operators trying to build long-term wealth. Healthcare entrepreneurs, are you ready to rewrite the rules for your business so you can have more time off, a great team, and more income while creating a positive social impact? Then you are in the right place. Welcome to The Provider's Edge. I'm your host, Sabrina Runbeck. I'm a provider, an international peak performance keynote speaker, and a best-selling author. Let's open the gateway to profitability for you today. My guests and I help healthcare entrepreneurs and startup founders like you break through barriers so you can control your business, control your life, and control your future. This is your defining moment to be a disruptor in healthcare. Hi, 𝘳. I'm so excited for you to be here. 𝘳𝘪𝘨𝘵 is the thought leader in the Canadian personal financial space, having written 3 books and hundreds of articles. He is a trusted resource for trending and context in the financial market. And of course, also a fellow podcaster of the Make Better Wealth Decision. And he acts as a fiduciary advisor to a selected number of successful families. So we're so excited to have you here on the show because we all know financial is one of those things. How do you define wealth is in so many different ways. But once you get into the details, do we actually have the right financial intelligence to make those decisions, whether it's to invest, whether it's thinking about where we should put our intelligence, our wealth into a certain startup or company or organization that could create our own legacy, right? And so these kind of conversation that you deal with every day and then really the behind scenes. So excited for you to be here. And so tell us a little bit more about what brought you to this point. What are that story that everybody wanted to actually learn about who you are?
So thank you, Sabrina. It's a pleasure to be here. And I've got a lot of different stories I can tell. So if you're going to ask me to tell a story open-endedly, how about if I do this? I wrote a book called Stand Up to the Financial Services Industry, where I showed how there's evidence that demonstrates that there are people who give advice who believe things that are simply not true. And that's a real problem because obviously you go to someone to get advice on the expectation that that person will give you good advice and will understand how things work. But this research came out 9 years ago, and it showed that in Canada, at least, there are people who sell mutual funds who do things improperly because they don't seem to know any better. They chase past performance, they don't diversify enough, they run concentrated positions, and they don't pay enough attention to how much products actually cost. So those are 3 things that are wrong, demonstrably wrong. Most people listening to this podcast will know that. And yet it seems as though the Canadian mutual fund advisors somehow haven't internalized that. And here's where it gets really hairy. These people not only gave that advice, which was wrong, which is scary because why are they giving bad advice? But the research showed that they actually did that same sort of thing, concentrated positions, chasing past performance, high cost products with their own accounts and even after they retired. And so the problem is not one of misplaced agency where they're trying to be sneaky and pull the wool over your eyes. The problem is actually more insidious, more ingrained. It's deeper than that because the problem seems to be that these people actually believe that what they're doing is right, even though they want to do the right thing. They're doing the wrong thing and they don't seem to know any better. So that's a real risk.
Yeah, when we talk about risk with investment, I think those are the critical things is how do we even know are we diversifying enough? Or are we putting too much money into a couple pots? Are they having the right trends to actually give us the return in investment? Or some people, especially in our sphere, we're very heavy into healthcare innovation. When you're thinking about investing in those companies, some people go in very early, and their risk profile is that if there is a right product, whether they're clinician backed and whatnot, and we really see the back end, I'm always be with all the startup we work with, is this even sellable? Right? Let's just not even talk about, can you scale later? Is this even sellable? Have you talked to enough people to even demonstrate that? Do you know how to talk to the rest of people to help us to feel like this is being de-risked, right? And then really thinking about the other side, right? And then it's the flip side, right? The people who are making the investment, do we even know how to ask those questions? How to really understand what a performance, early stage, mid stage, growth, later stage, where do we put our money in, right? So there's a lot of questions I'll play. When you are advising people to make those decisions, what are some of the critical things that you always going to ask or helping people ask when they're making those financial decisions?
So the most important thing is that you have to understand the profile, the risk tolerance and risk capacity of the person you're giving advice to. So you want to understand, what's your time horizon? How much can you afford to lose? What's your income? How much can you afford to save on a regular basis? When do you want to retire? Or maybe the money isn't for retirement. Maybe the money is to put your children or grandchildren through university or what have you. So you want to know, what's the money for? How much do you need? What's the time horizon? And then you build a portfolio that takes those parameters into account. So what I would say, Sabrina, is it's important that you diversify. So to use your example of healthcare, if you want to buy healthcare, then sure, buy healthcare. And if you've got a few companies that you have a loyalty to, or you know the founders, sure, you can put a little bit of your portfolio into that. But don't go hog wild. Don't go around putting 15 or 20% of your portfolio into that sort of thing. 5 or 10%, sure. But you should be diversifying within and throughout asset classes. So you're going to have stocks, you're going to have bonds, you might have some real estate, some commodities, what have you. You'll have domestic investments, you'll have foreign investments. And by having a broad variety of things, there's an old saying in finance that if everything in your portfolio was going up at the same time, you're probably doing something wrong. So if you have 8 or 10 or 12 different sorts of buckets that you're putting 8 or 10 or 12% of your money into each of those buckets, then it's unlikely that they'll all be going up at the same time. What you try to do is you try to find asset classes that are weakly or negatively correlated. That's a bit of a fancy word that means that some things will zig when other things zag. And if they're all going up at the same time, that's probably going to be hurting you, because if they're all going up at the same time, it means they'll probably all go down at the same time. But if you've got, say, 10 investments and most investments go up, so 7 or 8 or 9 of them are going up and 1 or 2 or 3 of them are going down, the net effect is that you have a smoother glide path. And for the most part, you're going to be going up almost all the time, maybe not quite as quickly, but you, A, seldom go down. And B, when you go down, it's not nearly by as much as it otherwise would be. So you should be able to have the focus and discipline to keep on going and keep on investing and getting to your longer term goal.
Yes, exactly. It's that also every single asset is also have a different pattern, right? For innovation space, for say, sometimes it's you simply just got into the trend, right? Healthcare AI is the biggest topics now, right? Everyone is trying to invest into healthcare AI. And then the next one is digital health, because that is how do we below access getting people to where they need without having to drive somewhere, wait for an hour before they get seen, right? So there are trends in the market that we can see, okay, then, and predictably next 3 to 5 years, especially, I think people also need to understand when you invest into a technology company, you're not going to get your money back for the next 3 to 5 years, at least. So the timing of, it's not like real estate, right? There's almost a predictable quarterly things that you can see, things can come back to you. So certain investment, you have to be comfortable about putting in there and allow the company to actually grow to a certain stage that they can exit, right? Or you can gain some of your equity back. So having that understanding of how tight your money needed to be, or maybe investing in innovation is actually, that's your legacy builder, right? Those are the bigger returns, because those things you can get 2, 3, 4, 5 times of your money back versus your stock of bonds. Those are smaller trends and growth, right? So be okay of where you put your money. I think for people to know that market trend, right, is also important. What are some other things that people often don't talk enough about? Or as you mentioned, there's things that they think they don't, but they actually don't know enough, or they're not asking enough to get the right questions.
Okay, so I want to touch on something you said a moment ago first, and then I'll get into the answer to the question. So what you talked about a moment ago is also called liquidity risk. Sometimes there are products that you might need a year or more before you can get your money out. And so what I was talking about a moment ago in terms of suitability, you need to make sure that if you put money into certain investments that are at a startup phase, where the founders need the money in order to get to a critical mass before they can have an opportunity to exit, you need to know that this is money that you're not going to be able to touch because you want to buy a second home or whatever else. This is money that you've socked away for a larger purpose, but that larger purpose is down the road. And in the meantime, you don't have access to that capital. And so you should make sure, absolutely sure, that under no circumstances will you need that capital between now and when you have that access. So that's one example of making sure that things make sense. To answer your question of a moment ago, you said, what are things that people don't think about? A lot of people don't think about the tax consequences of what they do. So, for instance, we're now into December, and a lot of people in December will do what's called tax loss selling, so that if things have dropped, they can sell them and use the losses associated with the things that have dropped to offset gains so that they can minimize their taxes. Similarly, a lot of people have made a lot of money in 2025. And so a lot of people might say, well, I want to reposition some of that money. And I know that I'm going to, if I sell any of this money, any of these things that have gone up, I'm going to pay tax. Well, if that's the case, maybe you should wait until January to sell things that have gone up. So you then defer your taxes until the spring of 2027, when you have to pay taxes on your 2026 capital gains. So again, to summarize, one example is if you have an investment that has gone down, you might want to sell it in December to use those losses to offset other gains. But if it has gone up, you might want to sell it in January so that you can defer your tax liability for another 14, 15, 16 months before you have to file your return for 2026. So those are the sorts of things that a lot of people, they think about, they like this investment or they don't like that one, but you can still sell one and or buy the other, but you might want to either accelerate selling one and you might want to defer selling the other, depending on whether they've gone up or down. And then you can still buy whatever you want with the proceeds when you've completed the sale. So that's an example of the sorts of things that people should be thinking about. If you're going to make better wealth decisions, you have to think about, well, not just do I like this or do I not like that, but how does this fit into my overall circumstances?
Our conversation so far really challenged the way we think about wealth, risks, and investing in innovations. John broke down why so many people, even professionals, still make emotional financial decisions, and why founders especially need to think about beyond the hype, trend, and fast returns. We also talked about the importance of diversification, liquidation, and asking the harder questions. Every founder needs to answer first, which is this actually sellable before trying to scale it? Now, before we jump into the rest of the conversation, let's take a quick pause and share something that many of you might find valuable to also stand out as a thought leader in this space. If you are an executive leading a company that's beyond Series A, or you are running a healthcare system, organization, ACO, payers, insurance, pharma, we would love to hear from you because your story matters on how you create impact and change. Go to theprovidersedge.com to apply to be a speaker on our show. We're so grateful for all of you who have been supporting us for the past years, and we are ranked at top 100 under entrepreneurships on Apple Podcasts and ranked globally top 2.5% of all shows. All right, let's get back to the second half of our show.
Maybe you had a really, really good year at work and you made more money in sales or got a bonus and you had a really, really high income in 2025. Again, if that's the case, you might want to wait until 2026 to take your profits because you're already going to be in a higher tax bracket in 25 because you made money on your day job. So those are the sorts of things that you can think about when you're trying to make better wealth decisions with your investing portfolio.
Exactly. It's that timing of tax, really thinking about like, where's the loss, where's the gain? And then what time of the year you should be thinking about cashing them out, or how do you put those money of the gain get back into investing again, right? So then you continuously to grow that passive income, and then that will help you to bypass some of the tax reasons because you reinvested. So there's multiple different things when people think about these reasons of, well, it could be then if you wanted to take things and you have to plan ahead, maybe other major decisions in life needed to plan ahead as well, right? If you're going to take a major vacation and that's the money that you're going to take out for that, right? Then you can plan accordingly and not just like, oh, this sounds great. I have some time off for spring break, right? Holidays, and let's just go, right? So there's things that we can really think outside of the box to support ourselves. And also for many people listening, they are already established leaders. They are also problem solvers, right? They are the type of people who see a potential and they wanted to act on it, creating their own innovation. So technically, you are also investing in your own company, right? So that's also another way of thinking about you. You might have all these other asset class diversification, but you also needed to save some to invest in your own company. I wonder, John, if you want to touch base on that in terms of tax benefits or how people really start thinking about when they're creating their own company, they need to invest in their own company. How does that work?
If you're starting your own company, that's a very niche way of looking at things. And you need to get legal support and you need to make sure that you are prepared to. The founders I know are quite prepared to be poor for a prolonged period and to take a modest draw, and everything they have is going into their business. And it tends to be, to use a baseball metaphor, usually a strikeout or a home run. There's not a lot in between. You either do very, very well or you spend a lot of time and energy and money trying to get your product to market, your service to market, to build a brand, to do whatever it is you want to do. And it doesn't always work. So the thing that I would say is entrepreneurship is a wonderful thing. And I would actively encourage anybody a lot of people are very good at self-selecting, which is to say some people just know they don't have the constitution. They don't have what it takes. They just want a day job, a 9 to 5. And that's fine. Those are the sorts of people who probably should have a 9 to 5 job. But the people who say, no, I want to build things, I want to leave a legacy. So for the people who have that mindset, they need to be prepared to make sacrifices along the way, to travel, maybe to take fewer vacations and to not eat at the fancy restaurants in order to put all they have into the company to build. Oftentimes it's sweat equity in the first 3 or 4 years until they can get to critical mass. And then hopefully they can find some people who will help give them some money for the next round of financing to grow to the point where you can be either do an IPO or be taken out by someone else and still make your money by having a business that's worth many, tens of millions of dollars that someone else can take out. So there are ways that you can do it, but I would say the most important thing is you need to think about your lifestyle and whether or not you are prepared to live on a beer budget if you have champagne tastes in the interim until such time that you can actually afford the champagne down the road.
Yeah, I think that's such a great point. We always talk about when individuals invest into startup versus they say, hey, Sabrina, I have a great idea. Can you help me to build it? Right? There's a fine line into it. It doesn't mean you cannot create your legacy if you're only investing in other technology. You can be part of that board. You can be part of that co-creation without having to put all your money, energy, almost like doing your full-time job plus this other part-time job, right? Vice versa, to devote all those in. So I think you can really create what is mean for you for wealth, for legacy, for power, for your family, right? For that ecosystem you really wanted to create for your community by investing into startup that you trust and backing and creating without having to do all the journey all by yourself or finding the right people to do it with you. So having that thought process of what does that mean for an investment, right? There's the investing in so many different levels of your intelligence, your training, and your time, your resources, right? As Xiang said, you have to learn how to even get other people to invest in the company, right? So there's a lot more to go into it, and not just the excitement of, oh, I'm an entrepreneur, right? I'm a serial entrepreneur. But sometimes we do see, even for people who had been successful exited in one industry, it doesn't always make sense in healthcare, or does that always make sense when you start expanding into other industry, because the rules and regulations and the support is very different. So
yeah, it looks glamorous. A lot of people think the life of an entrepreneur is glamorous, and they say, "Oh, wow, that sounds wonderful." I can tell you, I know a number of entrepreneurs, and they work very long hours, and they spend all their waking hours thinking about what they can do to expand their clientele, or to open up new markets, or to improve their products so they can sell more, more whiz bang products that can beat the competition. But they're not just, hanging up a shingle and saying, look at me, I'm great, I'm going to do this wonderful thing. There's a lot of risk, and it's worth it for many people, but, risk and reward are related. And the reason people who are entrepreneurs are rewarded so handsomely is because they take risks that most ordinary people are not prepared to take.
exactly. And that's why if you think about investing into any type of company and taking equity, why the co-founders have majority of the share, right? 50, 60% of the share. And then they opened up a 5% or 10% of investment equity share, because what you're putting in is helping them financially to get to the next milestone, but they have to do all the hard work, unless you're also putting in sweat equity or advising them to help them to co-create, right? So there's a different thought process of a reward, and but you have to give and take. So for all of us, really financial decision is thinking about what Qiang mentioned earlier, your lifestyle, how you believe money needed to come to you, how quickly is that cash flow? And one of the questions that we always ask startups when we help them to fundraise is that, what's your money mindset, right? Like, how are you deserving of money, spending money? Does the money come easy to you? Have you had an experience when you're growing up, right? And even for people who had a hardship growing up, but they learned a different thing, and they're not scarcity, right? So there, all of those come into play in how we make those decisions that make sense for us as we create our own personal ecosystem, family ecosystem, business ecosystem, and partnership, right? Everybody is working in congruency, collaborative in somehow, and not just very independent. So as we're wrapping up, Qiang, what do you think is your biggest advice that you wanted to give to our audience?
So here we are at the end of 2025, and the economy has done very, very well. The global economy is doing extremely well. And what I would say is, be careful. I wrote a book, it's over my shoulder there, called Bullshift, and it came out a few years ago. And I'm warning people against optimism bias. So bullshift is when the financial services industry shifts your attention to make you feel bullish. And right now, a lot of people are feeling bullish about a lot of things because things have been going very well. And that's usually the way things go in a mania. Things go very, very well until at some point they don't. And what I am asking people to do, my biggest bit of advice to your listeners, Sabrina, is to say, be careful. Don't be too complacent. You should be concerned about valuations. So I'll give you a couple of very quick numbers to give you an example of what I mean. The US stock market right now is trading at, there's this thing called CAPE, CAPE, cyclically adjusted price earnings, that a guy by the name of Robert Shiller developed and won a Nobel Prize for in 2013. The CAPE ratio for the S&P 500 right now is around 40, and historically it's below 20, which is another way of saying the US stock market is more than twice as expensive today as it has been historically. So there's a real risk there. I'll give you a second example. You probably know who Warren Buffett is. So Buffett has something called the Buffett indicator, which is the market capitalization of an economy divided by the gross domestic product. And again, the market capitalization for the US is usually defined by the Wilshire 5000 index. The market cap is the market cap, the GDP is a matter of public record. And once again, the Buffett ratio for the S&P for the US today in late 2025 is at around 220%. And again, fair is about 100%. So once again, the stock market has gotten way, way ahead of the economy. And that usually means that the stock market has to pull back significantly in order for things to normalize and to get to more traditional levels. I'm not telling you what you should or should not invest in, but I am saying that for stocks in general and for US stocks in particular, right now the market is extremely expensive. And you should consider that and weigh that when you make your wealth decisions. Everyone's different. Make your own decision. I'm not telling you what to do, but I am telling you what to consider before you do it.
Yeah, it's definitely, we have to be very much about knowing what to consider, right? Like knowing the reports and trends so we can make the best decision for ourselves. And also decision at the end of the day, it's still a gamble, right? We can make the best decision today, but all the factors later on in life can change that. But it's okay, right? Like we can always make another decision, another choice, and keep moving with our life, because things will always be punishable if you want it to be.
All right, this middle part of what we just talked about really highlights the emotional and practical reality behind entrepreneurship and investment. Zhang spoke about how founders are often investing far more than money. They are investing time, lifestyle, energy, and years of uncertainty to build something meaningful. We also unpacked how wealth and legacy can look different for everyone. Whether you're building your own company, backing innovation you believe in, or learning how to make decisions that align with the kind of life and ecosystem you actually want to create. So for all of you who are innovators, idea creators, change makers, you have a lot of ideas to pitch, and we would love to help you to get that more sound, more high value at less risk. Go to pitch2yes.com. We run monthly virtual events that get you to have a 2-minute pitch in front of operators, investors, and experts in the health, dental, and wellness space, and help you to see what are the 10 major things you do have to deliver at every time. And so you can truly create the impact and meaning that you meant to do. And for some of you who are just running a bunch of ideas, you do have to also practice your pitch, because if those ideas are not sound, you don't want to spend all this time, money, and energy building something that is not sellable.
So appreciate Zhang for sharing your expertise, your knowledge. People go check out Zhang's books. And we are so excited for you guys being here. We can't wait to hear from you. How have you been making those financial decisions? Whether it's diversifying your portfolio, start thinking about starting a startup company yourself, or simply investing in them. We continue to be here as a support.
Today's conversation brought financial decision-making back to reality for founders, investors, and innovators navigating many of these uncertain markets. Zhang and I unpacked the differences between hyped and sustainability, why entrepreneurship demands a completely different relationship with risks, and how long-term wealth is built through discipline instead of emotional investing. The discussion also explored the hidden sacrifices behind startup growth, the psychology behind money decision, and why sustainable legacy building requires founders to think beyond short-term wins. Here are the key things that we have learned today. Number one, most founders think they understand risks until the market tests them. Many founders and advisors make decisions based on confidence, trends, or excitement instead of truly understand risks. Myself and Zhang explore how blind optimism over-concentration and poor diversification can quietly create financial fragility, especially in fast-moving sectors like healthcare innovation and AI-enabled technologies. Number 2, diversification is more than a financial strategy, it's a survival strategy. This conversation expands diversification beyond stocks and portfolio into business strategy, partnership, and revenue stream. Founders who rely too heavily on one client, one investor, or one growth channel often create unnecessary pressure that limits long-term sustainability. Number 3, building a startup requires a different relationship with time and money. We discuss how startup investing and entrepreneurships are long-term games that require patience, liquidity plans, and emotional discipline. Many founders underestimate how long it takes to scale a company, especially in healthcare, where adoption cycles, regulatory bodies, and trust building take years. Number 4, entrepreneurship looks exciting from the outside, but it's built on sacrifice. Behind every successful founder story are years of uncertainty, long hours, delayed gratification, and financial pressure. We highlight that entrepreneurship is not just about innovation or freedom. It is about being willing to tolerate risks and sacrifices that most people are unwilling to make. Number 5, wealth is not about money. It's about alignment and legacy. One of the deeper themes in this episode was the financial decisions are often shaped by personal stories, emotional experiences, and the kind of life founders want to create. I emphasize that wealth should support a sustainable ecosystem for your family, your business, and your community, not just maximizing returns. Number 6, last but not least, sustainable growth comes from strategic decision-making, not hype. From tax planning and liquidity risk to market timing and founder psychology, the conversation reinforced the importance of thinking long-term. Founders and investors who succeed are often the ones who stay disciplined during periods of hype and making decisions based on sustainability instead of emotion. Now, let me ask you this. What is the one financial belief or money mindset you inherit growing up that still affect how you make business decisions today?
Thank you for listening. Remember, the positive change we're seeking starts right here with me and you. If you are a fan of the show, or if you are just having struggles or success that you're either experienced in the past or are experiencing now in the healthcare industry, these matter to all of us. I want to hear from you. Visit sabrinarunbeck.com/connect and send me a direct message. Talk soon.